Pound sterling to US dollar just collapsed 71 pips from the 2-month high. The pound hit 1.3550 yesterday, its strongest level since early May, and then US retail sales came in line with estimates, and the dollar snapped back. But here's the problem. Most traders are looking at this drop and screaming sell-off. That is exactly the trap. There is one danger zone and one hidden opportunity right now. I'll show you both. Here's the thing. The 4-hour trend is still flashing strong buy. The weekly trend is strong buy. The daily trend is strong buy. The only sell signal is on the 1-hour time frame. That tells me one thing. This is a pullback within a broader uptrend, not a trend reversal. But there's a catch, and it comes down to one number. Write this down, 1.3468. That's where we are trading right now. That's also the 100-day moving average, the 50% midpoint of the recent range, and the level where the 4H200 period SMA is sitting. If we lose this level, the entire bullish structure resets. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today, plus the one headline that flips everything. Let me be crystal clear about session bias. We are in a pullback within a bullish trend. This is not a trend change. This is not a reversal. This is a healthy retracement after a 400 pip rally from the 1.3143 Fibonacci support level that held in late June. The single invalidation level that flips this entire bias is 1.3390. Write this number down. If we break 1.3390 today, the entire structure resets and we are looking at 1.3325 and then 1.3200. But here's what most traders are missing right now. The herd is positioned long. Retail long positioning is stretched after that 1.3550 print. And guess where the stop clusters are? Right below 1.3460 and 1.3395. The smart money knows this. They're going to hunt those stops before the next leg up. Just this morning, Scotiabank strategists Sean Osborne and Eric Theoret noted that pound sterling to US dollar dips are buying opportunities, with gains toward at least 1.3650. And CityIndex is calling 1.3600 as the next upside target, followed by 1.3650, the May high. The path of least resistance remains tilted to the upside. But we need to navigate the noise first. Let's zoom out to the weekly chart first. Pound sterling to US dollar has rallied more than 400 pips from the 1.3143 Fibonacci level that marked the 38.2% retracement of the 2025 rally. That's a major structural low. The weekly RSI is at 58.575, still below overbought territory, which means there's room to run. The weekly ADX is at 33.21, confirming a strong trend in place, now drop down to the daily time frame. This is where it gets interesting. Yesterday, pound sterling to US dollar closed decisively above the psychological 1.3500 level, confirming a breakout above a key resistance zone that had previously capped the upside. The daily close above 1.3500 was the confirmation signal. But today we are trading back below it at 1.3468. That's a 52 pip retracement, and it's completely normal after a 146 pip rally with almost no pullback. Here's what most traders miss. Look at the moving averages. The MA5 is at 1.3445, MA10 at 1.3400, MA20 at 1.3376, MA50 at 1.3372, MA100 at 1.3391, and the MA200 at 1.3376. Notice something? All of these moving averages are clustered between 1.3376 and 1.3445. That's a massive support zone. The 200-day SMA is at 1.3376. The 100-day MA is at 1.3391. This is where the institutional bids are sitting. The MACD on the daily is showing positive momentum with a reading of 0.002, still bullish but losing a bit of steam. The CCI at 153.915 is elevated but not extreme. And the RSI at 58.575 is firmly in bullish territory but not overbought. Now the 4-hour chart. This is our trading time frame. The 4H trend is strong buy. Price is trading above both the 50-period SMA and the 200-period SMA, reinforcing the bullish short to medium-term trend. The recent breakout triggered that strong 146 pip rally with almost no meaningful pullback, highlighting strong buying momentum. But here's the retention bridge at 3 o'clock. Here's what most traders miss on the 4H chart. The Bollinger Bands are beginning to flare outward, an indication of expanding volatility and a classic bullish breakout signal. The alligator indicator, green lips, red teeth, blue jaw, are fanning out in a classic eating pattern to the upside, signaling strong bullish trend momentum. The short-term MRs are trading comfortably above the 200-period SMA, reinforcing the upward trend bias. The 1-hour chart is the only one flashing strong. Sell, and that's exactly why we are getting this pullback. The 1-hour sell signal is the noise. The 4H and daily buy signals are the trend. Key support levels I'm watching. S1 at 1.3424, S2 at 1.3308, S3 at 1.3240. Key resistance, R1 at 1.3608, R2 at 1.3676, R3 at 1.3792. The pivot point sits at 1.3492. We are trading 24 pips below it. That pivot is now resistance. Just this morning, a fresh analysis from FX to CO flagged that the 1.3501 handle on the hourly chart is the pivotal level signaling a potential shift in the medium-term trend. Below that, 1.3460 is the first support, then 1.3395. Let's connect the news to the price action because this is where the real edge comes from. The British pound was the best performing major currency yesterday, supported by a weaker US dollar and growing optimism over the UK's fiscal outlook. UK GDP rose 0.1% month-over-month in May, beating market expectations of 0% and improving from April's minus 0.1% contraction. The services sector, which accounts for around 80% of the UK economy, expanded 0.3%. That's the foundation of the rally. On the political front, sterling benefited from reports that incoming UK Prime Minister Andy Burnham is considering Shabana Mahmood for the role of finance minister. Markets view her as a fiscally disciplined candidate, reducing the likelihood of Ed Miliband becoming Chancellor and easing concerns over higher government spending and increased borrowing. UK government gilt yields are edging lower on the news. That's bond market validation. Meanwhile, the US dollar weakened for a second consecutive session, with the DXY approaching the key psychological level of 100. The DXY is currently at 100.78 after the retail sales data. Softer than expected US consumer and producer inflation data this week prompted investors to rule out a July rate hike from the Federal Reserve. Markets now price around a 70% probability of a 25 basis point rate hike in September. Here's the divergence that matters. The futures market is pricing in a lower probability of aggressive monetary tightening by the Fed, simultaneously signaling confidence in TWO hikes by the Bank of England in 2026. The first could take place in September. Markets are now fully pricing a 25 basis point rate hike in November, with another increase expected in March 2027. This policy divergence, dovish Fed versus hawkish bow, is the structural driver keeping pound sterling to US dollar bid. But here's the wild card. Renewed US-Iran hostilities are pushing oil prices higher. Brent is trading near monthly highs. Higher oil prices reinforce expectations that the Bank of England will tighten monetary policy, but they also risk reigniting US inflation concerns and lifting Treasury yields, which could support the dollar. Do you think the dollar breaks 105 this week? Comment yes or no. I'm tracking consensus. The 1 to 2 week directional lean remains bullish as long as we hold above 1.3390. The event that invalidates this? A break below 1.3390 on a daily close. That would signal the 400 pip rally is done and we are heading back to 1.3200. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 3 strategies, 2 scalps and 1 swing. Each one has exact entries, stops, and profit targets. And I'll show you the on-screen trade cards for every single one. Strategy 1. The opening scalp, scalping, high probability. This is the fast snipe. We're looking at the 5-minute chart for a structural trigger right at a key intraday level. Here's the setup. Price is currently at 1.3468, trading below the pivot at 1.3492. We are coming off the 1.3550 high. The 1H is oversold. What I'm watching for is a 5-minute bullish engulfing candle after price taps the 1.3460 support level, which is the first key support on the 4H. Exact trigger condition. Price taps 1.3460 and prints a bullish engulfing on the 5-minute chart. That's our entry signal entry, 1.3465, immediately after the bullish engulfing confirmation, stop loss, 1.3450, tight, 15 pips below entry. This is a scalp, so we're not giving it room. Take profit 1.3490, that's near the pivot at 1.3492. We're looking for 25 pips, roughly 1 minute, and 1.7 seconds risk reward, optional TP2, 1.3515 if momentum extends through the pivot. But for a scalp, TP1 is the primary target. What instantly voids this scalp? A 5-minute candle closes below 1.3460. That breaks the support level and tells me the liquidity grab is going the other way. The opening SCALP entry, 1.3465, 5M bullish engulfing after 1.3460 tap. Stop loss, 1.3450 take profit 1.3490 take profit 2, 1.3515, if momentum extends, risk reward, 1:1.7 invalidation, void if 5M candle closes below 1.3460 strategy 2, the liquidity grab, scalping, counter noise. This one is for the counter trend players. We're using the 15-minute chart to identify a clear stop hunt zone. Here's the logic. The herd is long. Retail stops are clustered below 1.3460 and 1.3395. The 1.3460 level is the first line of defense. Smart money knows exactly where those stops are sitting. They're going to push price down to trigger those stops, then reverse and squeeze the shorts, entry trigger. Price breaks below 1.3460, triggers the stop cluster, then prints a 15-minute bullish rejection wick back above 1.3460. That's the snapback confirmation entry, 1.3465, on the 15-minute close back above 1.3460 after the fake breakout, stop loss, 1.3445, just below the wick's low. We need to be outside the fake out range target, 1.3492, the pivot point. That's the nearest intraday liquidity pool where shorts will cover. Warning, this requires fast execution. The fake out can happen in minutes. You need to be watching the 15-minute chart live. Strategy 2 entry, 1.3465, 15M close back above 1.3460 after fake breakout, stop loss, 1.3445 take profit 1.3492 risk and reward, 1:1.35 invalidation, void if 15M candle closes below 1.3445. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Strategy 3, the session swing. Trend alignment. This is the big one. Based on the 4H and daily bias, this is the trade that captures the multi-session move. The structural setup is simple. The 4H trend is strong buy. We've had a 146 pip rally with almost no pullback. A retracement to the 1.3460 to 1.3424 zone is exactly what we want to see before the next leg up. The 4H 200 period SMA is providing dynamic support in this zone. Trigger condition. A 4H candle closes above the 60 period moving average with bullish MACD crossover confirmation. The MACD on the 4H needs to show the histogram turning positive again after the pullback. Entry, 1.3480, on the 4H close above the 60 MA with MACD confirmation, but here's the alternative entry. If you want to be more aggressive, you can enter on a 4H bullish engulfing at the 1.3424 support level. That's S1, and it's a high probability bounce zone stop loss, 1.3390. This is critical. 1.3390 is the level that, if broken, invalidates the entire bullish structure. It's the 100-day MA, the 200-day MA, and the 50% midpoint of the broader trading range. If we break 1.3390 on a daily close, the swing trade is done. Take profit 1.3600, that's the July high and the next major resistance. Take profit 2, 1.3650, the May high. This is the stretch target if momentum continues. Risk reward on this trade. Entry at 1.3480, stop at 1.3390, TP1 at 1.3600. That's 90 pips risk for 120 pips reward. 1:1.33R. TP2 at 1.3650 gives us 170 pips reward. 1:1.89R. Trailing stop rule. Once price reaches halfway to TP1, around 1.3540, move your stop to break even. Let the trade run. Explicit invalidation. Daily close below 1.3390. That shifts the medium-term outlook from bullish to neutral, and we are looking at 1.3325 and then 1.3200. Strategy 3. The session is the entry. 1.3480, for H close above 60 MA with MACD cross, or 1.3424, for H bullish engulfing at S1, stop loss. 1.3390 take profit 1. 1.3600 take profit 2. 1.3650 risk reward. 1:1.33R, TP1. 1:1.89R, TP2, invalidation. Void if daily close below 1.3390. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. I'm risking 0.5% on the scalps because they're fast and tight. The swing trade gets the full 1 to 2% allocation. No positions through high-impact news. Stops are non-negotiable. This is how you survive to trade the next big move. Let me summarize the single most critical level for the next session. 1.3390. That's the line that separates a bullish continuation from a bearish reversal. As long as we hold above 1.3390, the bias is buy the dip. The 400 pip rally from 1.3143 is intact, and we are targeting 1.3600 and then 1.3650, but if we break 1.3390 on a daily close, the whole monthly trend flips. We are looking at 1.3325, then 1.3200, and the bullish narrative is dead. Tomorrow's wildcard? US PPI data. If we get another soft inflation print, the dollar gets crushed and pound sterling to US dollar explodes through 1.3600. If we get a hot print, the Fed hawkish repricing could send us straight to 1.3390. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter. Scalp the noise. Swing the trend.